Good afternoon, everybody. Today we are going to get into Chapter 6, which is going to talk about taxes and tax planning. So our tax code is based on the idea that, hey, guess what? We all got to pay to finance the government and all its activities. And there's various interpretations or the ability to pay if you're in lower income tax, lower brackets, you may not have to pay taxes. So we're going to talk about at all the different levels that the government imposes tax. We're going to talk about the different types of things that may be taxed. And we'll mention a little bit on progressive tax. So of course, Congress determines tax code. Every year, at the end of the year, they're going to pass a law generally associated with taxes, and they generally wait to the last minute. You won't see it till late November this year. It was, a couple days before, a couple days after Christmas when they signed into law the Tax Cuts and Jobs Acts. That's going to change things up for this year. As things have changed, as the economy have changed, as depending upon what the government needs financing for, laws change and come in, go away, et cetera, depending upon the goal and who's trying to get elected. This year with the Tax Cuts and Jobs Act, it was aimed at improving the tax rate for corporations, but they also included some individual things to ensure that the law got passed. If we're going back in war times, tax rates are going to go up to help finance the war effort. Because of all these different laws, all these different changes that happen each year, guess what? It's complex, it's unreasonable, it can be illogical at times. There is a lot to tax code. The IRS does not understand all of the things about tax code. You could call them up with a question, talk to 3 different people, and maybe get 3 different answers on how to handle a specific issue. Ideally, it has a purpose: collect the revenues of the government. There is some logic there, have everybody pay, but it kind of takes a downturn after that. So we got a progressive tax system is how our federal income tax is done. And as your income goes up, the tax rate goes up. And higher levels of income are taxed at higher rates. And you can see an example of that in your textbook based on the rate structure from a few years ago. Or you can go look online and just type in 2018 tax brackets and see where you're going to fit in here in the coming year, or in this year. So what different types of taxes do we have? Well, of course, we've got income taxes. So we could have federal income taxes, state income taxes, or depending upon where you live, your local city or county may be imposing an income tax on you. And we have different types of income. We've got our wages from doing our jobs. We could have interest income. We could have dividend income from our investments. We could have capital gains from selling our investments. We can have rental income, royalty income, or self-employment income. And we'll get into all those and where they show up in a little bit. Generally, states or municipalities are going to have some form of sales or consumption tax. You're going to be taxed on the goods that you buy. And those, once again, rates varying depending upon where you are. Some states don't have a sales tax. They more than likely have a much higher income tax than other areas to make up for that missing revenue. North Dakota here, we've got a sales tax. Our income tax isn't too bad, just a few percent. We could have a value-added tax where the taxes go on to the manufacturers and when things are being produced. We could have an excise tax where just specific items are being taxed. You'll see that federal, state, and local as well. If you look at the gas pumps, whenever you go fill up, generally there's going to be a sticker on the pump saying, hey, where are your tax dollars going? This percentage is the federal gas tax, this percentage or this amount of cents is the state gas tax for every gallon that you're filling up. Taxes on tobacco, taxes on certain imports are going to be examples of excise taxes. You could have property taxes. You buy a house, you're going to generally have to pay a local property tax on the value of that home to fund your local government and your local schools. Some states may have your vehicle tax based on the value of it. So you could have a property tax there as well, once again depending upon where you live. And we could have an estate tax depending upon the value of your estate once you pass away. So of course we use all this as a source of financing, or the governments use this to finance, to pay for everything that they're doing. Pay for building the roads, pay for schools, etc., etc. So we've got all those different examples like we talked about within the chart. And like I said, the federal income tax is based on a progressive tax. The higher you go on the income, the more you're getting taxed. So this next section, we're going to talk about taxes and personal financial planning, talking about your taxable income and the schedules where we can report them, looking at deductions, exemptions, credits, and your payment. We'll talk about the result at the end of the tax return. So we got lots of different entities. This is more looking at a business perspective that can be taxed. So you as an individual is taxed, like we just talked about. If you start a business and form a corporation, that corporation is getting taxed. You could have a nonprofit corporation where most of what comes in isn't going to be taxed, but there may be certain transactions that the nonprofit has to pay tax on, investment-related things. And we could have trusts, which is another business form that to hold income and distribute it to the heirs or owners of the trust, which would also pay taxes. So for federal income tax, we're going to have filing. And we could file single, married filing separately, or head of household. Generally, if you're married, it's more beneficial to be filed as married and together. Married filing separately, we lose some tax breaks, some deductions that we have if you do that, but some people do it for student loan purposes, consider themselves separate to get a better break on a student loan repayment plan. Head of household means you're single, but you're raising a child. You can file as head of household for a little extra standard deduction. So we've got all the different forms of income that could come into play. As far as our wages, our interest, our business income, our capital gains, our rental income, and our farming income, and they're all going to show up on a different schedule. Your wages, you're going to get a W-2 at the end of the year. And that's going to have your gross income, what you're being, or your taxable income, I should say. What's your income for Social Security, your income for Medicare, your state income, and then all the withholdings for those things. And then depending upon all the income that you have, like we can see here, it's going to go on a different tax form. So interest goes on Schedule B, business income on Schedule C, capital gains on D, rents and royalties in E, and a farm, Schedule F. And then if you are a business owner, if you are a farmer, you're going to have self-employment tax on your net profit from those entities. Then from there, we put all our income together, subtract our 4 AGI deductions, and that gets to our adjusted gross income. And then from there, we get to deduct our standard and personal exemptions and any tax credits that we have, and that reaches to our taxable income. And then depending upon where that income falls in the tax tables, determines the amount of tax that we got to pay. And then the taxes that we got to pay is going to be compared to what's being withheld. So like I said, on your W-2, it's going to have what was withheld for federal income tax throughout the year. The difference between those and what you owe is going to be whether you get a refund or you got to pay some more in. If you're in a situation where not enough is being withheld, you have the option to pay in estimated taxes. So those are to be filed at the end of every quarter, where you're essentially yourself paying in on what you're expecting to owe at the end of the year. And you can get interest and penalties for not paying in enough tax throughout each quarter. They want you, the government wants you to evenly pay in your taxes throughout the year because they need to collect it and pay for everything that's going on. So ideally, you'll get a refund, but you know, it all depends upon how your withholding is set up. When you fill out your W-4, the higher number you claim, the less that's being withheld. The lower number you claim, the more is being withheld. So if I claim a 0 on my W-4, the maximum amount is going to be taken out. And I can claim 0 and married for if you're married, or you can claim 0 and single, even if you are married, to get a little more taken out. But you remember, if you're getting a refund, that just means you're getting your money back that the government has taken from you in most cases, depending upon what tax credits you may have qualified for. So I mean, ideally, we'd get to the end of the year and world according to Dustin, we'd break even and move on with our lives. But you know, depending upon your perspective, you can use a tax refund as a de facto savings account. So that money's there, you're going to get in a lump sum at the end of the year rather than putting in the diligence to be saving month after month after month. It is one option. But once again, depends upon what your withholding is, depending upon all different types of factors that may affect your tax return that we'll take a look at here in a second. So once again, I just put a summary of our tax forms. Our 1040 is our personal return. Our Schedule A we use for itemized deductions. Our Schedule B for interest and dividends. The C and F for a business or a farm. D, capital gains, and when we're selling investments. Schedule E, rental property. And I was just going to go through an example of each of these forms. So if you go look into Moodle, I've put last year's tax form for each one in there just for your reference. One caveat I'm going to put on this is because of the Tax Act and the Tax Cuts and Jobs Act, stuff on here isn't necessarily going to be applicable to us right now, but it's a work-through process. The IRS is still putting together all the information. They aren't going to release these forms till late in the fall, what the actual tax form for next year is going to look like. But the first part of our tax form is income. Putting in our wages, putting in our interest, our dividends, our net income from our businesses, our capital gains. If we take retirement distributions or pension distributions, if we have rental property, if we have a farm, if we've drawn unemployment, if we've drawn Social Security. So basically between 7 and 21 is all the different ways that we could have income. And guess what? Unfortunately, unless it's specifically stated in tax code, it's income. Now there's a lot of types of income that are not subject to tax. That's an article that I'll have you take a look at within your next assignment. So we've got all our income, and that comes together on 22. The next section is our above the line or for AGI deductions. So we've got certain things that we can get a deduction for. Educator expenses. K through 12 teachers can deduct $250 of supplies for their classrooms. If you contribute to a health savings account, deduction. Moving expenses is gone except for military. If you get hit with self-employment tax, part of that is going to be deductible here. If you're contributing to a retirement plan, whether that's a SEP plan or a traditional IRA, we can get a deduction for that. But that has to be a plan that you're going to get taxed on in the future. If you contribute to a Roth IRA, which is non-taxable, we can't take a deduction for that here. If you're self-employed and pay your health insurance, we get a deduction there. Student loan interest up to $2,500. Something that may become very pertinent for you here in the near future, depending upon how close you are to graduation. And then from there, we get to our adjusted gross income, which is a number that is used to base some other deductions on. Then we get to take either our itemized deductions or a standard deduction. And now that's a big change in the Tax Cuts and Jobs Act. That standard deduction is $24,000 for a married couple, $12,000 for a single individual next year, as opposed to where it was $12,600 or $6,300 last year. Traditionally, we had personal exemptions. Last year of $4,050 per dependent on a return. That is gone. That does not exist this year. So basically our AGI minus our standard deduction or itemized, which we'll take a look at in a second, gives us our taxable income. And then we're going to come up with our tax liability, what we owe for taxes. We may reduce that tax liability by certain tax credits we have access to. So you could have a tax credit for what you pay for daycare. If you have investments where your foreign income tax is withheld, you may get a tax credit for that. The retirement savings credit is really tough to get. You have to be in really low income brackets for that one. The child tax credit. That's another thing that's changing by the Tax Cuts and Jobs Act. So credit you get for children 16 and younger. Residential energy credit. You can get a credit for certain improvements on your home that save energy. So our tax minus our credits gets us down here. And then we may have self-employment tax if we're a business owner. We may have a penalty for not having health insurance. That's going to go away in 2 more years. All that comes together to be our total tax. We compare our total tax to what we've paid in. So all our withholdings, any estimated tax that we paid ahead, and then certain what they're called refundable credits. So if we had some that we didn't use up here, we could bring them down here for education. The American Opportunity Credit you can use for their first 4 years of college. Additional child tax credit, earned income credit. So the difference between your tax and everything that you've paid gets us down here. Do you get a refund or do you have to pay some money? However it turns out, and like I said, could be a penalty on not paying enough in. So that's your 1040. Schedule B, you take a look at, it's got a spot for interest and dividends. If you have money in the bank, if you have any type of investments. Schedule C, if you're a business owner, this is a basic income statement. What did you bring in? What did you spend out? Getting down to your net income. Schedule D is capital gains. So basically selling investments for more or less than we paid for them. We got to deal with capital gains tax. And generally capital gains tax is going to be less than your regular income tax as long as you've held the asset for less than a year. Schedule E would be rentals or royalty income. Once again, a basic income statement. How much rent did you receive? What were your expenses? And then Schedule F, same thing but for farmers. Once again, a basic income statement. What income did you take in from farming? What different expenses that you had? And the net results of all of these forms is what shows up on page 1 of the 1040 in that top half, looking at lines 7 to 21. Get the results from all these pages. So in a nutshell, kind of here, that's all our tax forms. So we got to keep in mind with our planning, with our budgeting, what our income tax is going to be or what effect that's going to have. Knowing how we file our taxes for various types of income, what tax it is subject to. We've got our various deductions that can reduce our taxable income. We've got our credits that can reduce our tax liability. And then how do we get the money in the system? Either through withholding or through estimated quarterly payments. And we get down to, do we get some money back or do we have to pay in? And hopefully as a result of the Tax Cuts and Jobs Act that you'll come out a little ahead this year. At least that was the intent. It's going to affect everybody differently. All depends upon your circumstances and all those different types of incomes. What do you have? What your family status is, etc., etc. Please don't go, oh, my buddy got a huge refund. Why didn't I? Everybody's different. Everybody has different variables and factors that go into their tax return. So we're going to talk about where we get our tax information. We're going to talk about record keeping. They have some stuff in the textbook you can see there on tax preparation assistance. If you ever have questions, you can shoot me an email at any time after this class is over. I'll be gladly to provide you with any advice. So there's lots of record keeping that goes on. Businesses have to file their W-2s, their 1099s, all that documentation with the IRS. And then that way the IRS has the information so that they can verify it against your tax return. So with some things, they have the information. If they have the information, you're going to be stuck with it. So here's an example of those forms. So like I said, W-2. Employer sends it in, you put it on your tax return. 1099 interest, the bank sends it in, you put it on your tax return. 1099B, that would be capital gains and all your investment information. Investment company sends it in, you report it. Retirement income, 1099R. If you're self-employed or an independent contractor, you'll get a 1099 miscellaneous with the amount of income that you earn that you'll have to report on a Schedule C. So there's that checks and balances that the IRS has in place that requires, basically to keep everybody honest, even though there's a lot of honesty in the rest of the return outside of these forms. But the expenses are only known by you. Your deductions are only known by you. And in order to take them, we've got to have proof. So please save your receipts. Get in that habit of filing those away if it's something that may have tax consequences or tax benefits, especially if you're going to have a small business, you're going to have a farm, whatever. So keep track of those things that may be tax related. If you're a small business person, please use QuickBooks to keep track of your expenses throughout the year. You need this proof to be able to claim them as a deduction. If you're going to use the itemized deductions, which I'm just realizing I forgot to talk about a few seconds ago, for donations, for medical, you need proof of those things. But with the higher standard deduction, itemizing is pretty much going away in the future. So then you got to file. You either got to do it yourself or you got to hire a tax preparer. So there's lots of options, TurboTax, Tax Act, etc. Or the forms that I just went through. You can fill those out and send them in. So we got to e-file, or we got to send it in the paper way, especially if I would recommend e-filing in these times, just to not have to deal with things getting lost in the mail and fighting with the IRS after the fact. As far as saving ourselves on taxes, we've got tax evasion and tax avoidance. It is completely 100% in your right to avoid taxes. We can do different things to lower the amount of our tax bill. As long as they're legal, as long as they're allowed, that is fine. Contribute to an IRA, contribute to a health savings account. Do an energy efficient property improvement. You can use those things that are legal to lower your tax bill. Invest in a bunch of municipal bonds that are not taxable. So the interest, you get off that tax-free. You can use strategies like that to save yourself some money. Whereas tax evasion, you're trying to defraud the government. You're not reporting income that you know you had. So there's a fine line between doing what's legal and what's not. We can always find tax code from the IRS. Go to irs.gov and see what the rules are. So for example, we can pull up here the website. I can find the directions for any of those forms within tax code here. I could just come up here, Schedule C. Instructions for Schedule C. There you go. The government's not hiding this from you, but it is very complicated. I'm not going to lie on that. But it is out there and you can find it. For further information on that, this fall, take my individual income tax class. I may be a little biased here, but I think everybody should have the ability to do their own tax return. And I will, depending upon the complexity of your situation. Now, if you've got various corporations and investments and things like that, okay, maybe it's better to hire a CPA. But I think for basic tax returns, everybody should be able to do it. And I will give you the skills in that class to do it. And even if you're an online student, it's an on-campus class, but you can dial in through Ivan or you can watch the recorded lectures later. So there's my little pitch. For more information on this, take that class. So keep your records, keep your receipts, Assistance is out there. Be careful. Don't take different tax positions that you know are fraudulent, because you can get audited and get in trouble for that. Don't be a tax evader, but we can use legal ways to lower our tax bill. And then now we're going to take a look at how taxes may change throughout our lives. So generally, depending upon what stage of life you're in, it's different things that you have to take into account. You know, if you're relatively a young person still in college, you're not making a lot of money. You don't have a lot of assets. You're going to have low income and low expenses. Once you get out of college, you get set in your career, you get a family, you get children, your income's going to go up. As you have those different things, you're going to have higher income, but you're also going to have higher deductions and tax credits. As you get older, maybe you've got a lot of your debt, you're getting that paid off, your income's going to be at the highest of your life. What can we do with that to then save ourselves in taxes? And then as you get to retirement, you're probably not going to have as much coming in. You're probably getting rid of assets. You would have a little lower income, but you're not going to have as many deductions as well. And you can contact a financial advisor, a certified public accountant, to help you as you go through the various stages of life. But once again, keep in mind your goals and what do you want to accomplish in the future. Please don't do something just for a possible tax benefit, or just not do something because of taxes. You know, I mentioned like a residential energy improvement. It could cost you $10,000 to put windows in your house. You know, you get a credit of a couple $100. Don't do it just for that reason. But just keep in mind the implications of tax code on whatever choices you make. When you get into business yourself and you have to deal with self-employment tax and be saving to be able to pay that off, paying in quarterly taxes. Keep that in mind as part of your goals. So do what you want, figure out how to get it, and figure out how to protect it. And there are different strategies that we can do to move the money to save you from taxes, depending upon your type of investment, depending upon what type of retirement account you're contributing to. And they close out with just a little quote from Ben Franklin, keeping in mind that, hey, that's how this country started, is because people were angry about taxes. And here we're still dealing with them 250 years later. So just keep that in mind. That's the biggest takeaway from this, is keep in mind the possible tax effects on your decisions, your financial decisions throughout your life. So there's chapter, 6? Chapter 6 on taxes. If you have any questions taking this further, please don't hesitate to let me know.